Which insights can we gain from doing a DuPont analysis? If you want to successfully apply DuPont analysis, you need to know how to calculate its components, decide what to compare to, and most importantly, apply a structured approach to interpreting the numbers. Let's use a real-world example, industrial gas company Linde. The return on equity formula puts net income in the numerator and equity in the denominator. If we pull up the latest income statement, we find net income near the bottom of the page, $6.3 billion in the year 2023. If we pull up the balance sheet, we find the opening balance and the ending balance of equity for the year. The average of those two numbers is $41.2 billion. Divide $6.3 billion in net income by $41.2 billion in average equity, and you get to an ROE of 15.4%. Now let's split that ROE into three parts: net income over sales, or return on sales, sales over assets, or asset turnover, and assets over equity, or leverage. We have already found net income and average equity, so let's put these into place. Sales, just like net income, can be found in the income statement. Assets are on the left-hand side of the balance sheet. Assets, just like equity, have an opening balance and an ending balance. The average of these two numbers is $80.2 billion. That completes the input into the DuPont formula. Let's see what the results are. Return on sales of 19.3%, asset turnover of 0.41, and leverage of 1.95. Multiplying these three components of the DuPont formula gets you to the same ROE of 15.4% that we saw earlier. So is that good or bad? How do these numbers compare? How do we interpret this DuPont analysis? You have two choices here. Either compare the ratios to the historical performance of the same company or to the same year performance of a competitor. In this video, we take the first route. We will compare return on equity and its components over the years. We already calculated 2023, and we'll leave those numbers in place. For 2022, using the data in the income statement and the balance sheet of that year, we get an ROS of 12.8%, an asset turnover of 0.41, and leverage of 1.86. In total, return on equity of 9.9%. 2021, ROS of 12.9%, asset turnover 0.36, leverage 1.79, ROE 8.3%. 2020, ROS of 9.6%, asset turnover 0.31, leverage 1.73, ROE 5.2%. Over those 4 years in our sample, ROE has gone up significantly, from 5.2% in 2020 to 15.4% in 2023. ROE nearly tripled. What was the main factor that contributed to that increase? Return on sales doubled, while asset turnover and leverage also moved up, but much more modestly. So on our quest to find the story behind these numbers, let's focus on the big impact factor first. How did return on sales develop over the years? If ROS goes up, then most likely net income has grown faster than sales. This is where we pull in another financial analysis tool to dig deeper and help us gather insights. Hello DuPont analysis, meet horizontal analysis. Horizontal analysis is used to evaluate a company's performance over time, spotting the direction of change in account balances and the magnitude in which that change has occurred. Let's do a simplified version of horizontal analysis. Rather than comparing each year to its previous year, we compare the latest year in our data set, 2023, to the oldest year in our data set, 2020. Net income, the numerator in the return on sales calculation, went up by 141%. Sales, the denominator in the calculation, went up by 21%. So our suspicion was correct. Net income has grown faster than sales. But how can net income grow that much faster than sales? This is where I have to take a look at some of the larger line items between sales and net income. And when I say some, I mean only those that really make a difference. In finance language, the material ones. First of all, cost of sales. This has gone up by only 14%, while sales went up by 21%. Let's play the game of spot the anomaly to see if we can find a specific year that is an outlier. From 2020 to 2021, both sales and cost of sales go up in similar proportions. Similar story for 2022. In 2023, sales are down 2% versus prior year, whereas cost of sales is down 10%. That's where the anomaly is. And the narrative in the MD&A section of the annual report provides insights into the drivers. The main ones are lower volumes, which affect both sales and cost of sales, higher pricing, which increases margins, and productivity gains, which decreases cost of sales relative to sales. If cost of sales had grown by 21% from 2020 to 2023 instead of 14%, then cost of sales would have been $18.6 billion in 2023. This is a margin improvement for the company of $1.1 billion pre-tax. Next up, selling, general and administrative expenses. These only increased by 3% from 2020 to 2023, whereas sales increased by 21%. The company cites continued productivity initiatives as the factor to contain costs. If SG&A had grown by 21% in line with sales, then 2023 SG&A would have been $3.9 billion, $600 million of cost avoidance. Depreciation and amortization is a separate line item in Linde's income statement. And strangely enough, it has gone down by 18% over the 4 years. Let's look at the underlying numbers. Regular depreciation and amortization has gone up slightly over the years, whereas the purchase accounting impacts have steadily decreased over time, from $1.9 billion in 2020 to less than $1 billion in 2023. These purchase accounting impacts are caused by the merger of equals between Praxair and Linde, which was completed back in October 2018. The sum of the regular depreciation and amortization plus purchase accounting impacts adds to the reported numbers in the income statement. The last significant line item to review is other charges. It doesn't make sense to calculate a percentage change here, as these are lumpy chunks of one-off expenses. The amount in 2023 is far lower than in previous years, which is favorable for profitability. Let's play the game of spot the anomaly again. Two outliers, 2022 at $1 billion and 2020 at $0.5 billion. Other charges in 2022 were caused by the deconsolidation and impairment of Russian subsidiaries. Other charges in 2020 were due to restructuring steps as part of the merger integration. What our horizontal analysis shows us here is that 4 major expense lines have either decreased over time or have grown at a slower pace than sales, causing net income to grow very impressively. Our DuPont analysis hinted to us that net income has grown faster than sales. Our horizontal analysis quantified that net income has grown 141%, while sales grew 21%, and provided us with the operational drivers, the narrative, the story behind the numbers. Higher pricing, productivity improvements, and decrease in purchase accounting impacts, as well as unusual items. That's our first component, return on sales, taken care of. What can we say about asset turnover? Well, if you have done a DuPont analysis before, for companies in other industries, you would probably say asset turnover of 0.41 in 2023 is relatively low. Lower, in fact, than companies in the hugely capital-intensive telecom sector. Let's review the denominator in the asset turnover calculation. Is there anything in the asset base that is unusual? Spot the anomaly. $26 billion of goodwill and $12 billion of other intangible assets. Those are very big numbers on a balance sheet total of around $80 billion. And they are purely accounting driven, relating to the merger of equals between Praxair and Linde. What if we calculate total assets excluding goodwill and other intangible assets, and then use those numbers to calculate asset turnover? Making that adjustment pretty much doubles the asset turnover in each of the years and is more representative of the operational performance of the company. When comparing to competitors, asset turnover, excluding goodwill and other intangible assets, might be the more relevant metric, as this provides a level playing field between companies that did versus those that did not grow through mergers and acquisitions. Now that we understand ROS as well as asset turnover, what can we learn about Linde's leverage? If you look at the leverage number from the oldest year at the bottom to the latest year at the top, you see it increasing slightly. This is unusual, as a lot of companies are currently deleveraging now that interest rates are higher and borrowing is no longer free or nearly free. Where is the increase in leverage coming from? It makes sense to look at the numbers of average assets and average equity for 2020 and 2023. Over the years, average assets have gone down $7.2 billion, or 8% versus 2020. Average equity has gone down $9.3 billion, or 18%. So that's the input we're going to review in more detail. This is where the statement of changes in equity comes in nicely. It provides a walk from the opening balance of equity for the year at the top to the closing balance at the bottom. A positive net income makes equity go up, while dividends and share buybacks make it go down. In the case of Linde, over these 4 years, $17.2 billion in cumulative net income has been added to equity, a number we can also find in the income statement. Over the same period, $25.2 billion in cumulative dividends and share buybacks has been deducted from equity, numbers we can also find in the cash flow statement. So the answer to our question, why has leverage gone up, is fairly simple. Equity on the balance sheet has decreased significantly as cumulative net income earned is far less than the payouts for cumulative dividends and share buybacks. This made equity go down faster than assets, so leverage went up. With that, we have successfully used DuPont analysis to gain insights into how the company works. Analyzing return on sales, asset turnover, and leverage provides a solid understanding of return on equity. If you want to successfully apply DuPont analysis, you need to know how to calculate its components, decide what to compare to, and most importantly, apply a structured approach to interpreting the numbers.